Hey guys, welcome back to the channel. So give you a little sneak peek of what goes on behind the scenes when we produce some of these instructional videos. I always like to have a lot of takeaways and things like that. So they're never scripted, but I do have some notes and some bullets, and I want to make sure I communicate those takeaways that are effective to help you in your journey as a trader. So I'll have sort of production notes and things like that. But sometimes you just gotta flush the format. Okay, so warning to the production team. I'm going to wing this one, all right? But it's a key takeaway and an experience that happened to me actually overnight, speaking with my managed account counterparts, some partners overseas. And they're valid questions, but I thought I'd share it with you. And I think it's going to help you with your journaling and KPI metrics to help you as a trader. So let me communicate that to you. And also, if you have any experience on the managed side, and even if you don't, this will give you a little taste of kind of what to expect. So when you're overseeing funds that are not yours, you usually have, an investor or a group or partners, things like that. And there's always that one person who kind of asks a lot of questions, and especially during our monthly wrap up. So I'm doing a monthly wrap up for September, and one new person kind of asks a lot of questions. A lot of times their accounting people has a lot of questions, so they, in forward, ask me. Happy to answer them as long as they're legitimate questions. So the one question the gentleman asks is, what's our risk reward? I said, what do you mean? All right, risk reward of what? Risk reward on a trade, risk reward on a portfolio, what type of risk level and risk of ruin is there, things like that. So obviously he meant like on a trade. And I said, well, it depends. It varies based on strategy, things like, and a lot of other variables, which actually we'll discuss on a different video. So he kind of pushed it a little bit and said, well, it's a simple question. I says, well, not really, because I don't really have the answer to that, because really don't track it. I says, why? I says, well, what exactly do you mean? I believe profit factor for a particular strategy is more valuable. It tells you how much money you're making on average every time you push the button. And the other thing I brought up was, okay, let's say I say your risk reward is 1 to 5. What if I said that? So for every unit we're risking, our goal is to make 5. Or what if I said it's 5 to 1? In other words, we're going to be risking 5 units to make 1 unit. Would your opinion change? And he says, yeah, that's crazy. I says, well, risk reward is linear and it really doesn't matter. It all depends on the overall profit factor of a strategy. You can have a 90% success rate and fail, or a 10% success rate and just be crushing it. So I tried to explain, and I could see I was sort of losing the battle. All right, and there was some language differences there as well. So, I'll give it. But in a sense, there was a customer relationship. In a sense, I was trying to be very cordial and professional. So he continues and says, okay, so and the average risk reward approximately was less than 1 to 1. Of course, that raised flags because an average person say, wait a second, you're risking more than what you're gaining. Isn't that risky? I says, well, let's look at risk of ruin. That's more important. So in all our charters, our risk of ruin cannot be more than 0.2 of 1%. So basically, you can't really go broke. All right, you can't blow the account or whatever framework you have, the partnership. So that should be reassuring. But they kept focusing on the risk reward per trade. So I put it this way, and generally a lot of the strategies that I use have sort of a movement of the risk. I do give a little room there for the trade to price action to fluctuate a little bit. All right, because there are strategies on how to exit with small losses, and I want to have the opportunity to do so. If I have my stop jammed right below like a 3-minute bar, there's no chance to get out. It's just the stop is a stop. But what happens is once the trade starts to work, and that may be going after fluctuating between profits and loss or even a loss, I'll start moving my stop to reduce the risk and ultimately, a trade at break even. So what I imply to him and what I do is try, and again, it's an advanced topic and I want you to think about, is this a place for you to include in your KPI journal and KPI metrics? How do you measure risk? And this is something that even some quants don't really use, but I promote this with my managed accounts and also, those when I do speaking and things like that. So here is the little sort of in a nutshell way of measuring it. If you move your stop right? After a trade is working out or whenever you do it. The real ultimate risk, and this is what I explained to this partner, is if my risk is at the initial risk reward, X, and I move my stop, well, at some point, what is the duration of the trade and how long was my initial stop in that specific place? So when we talk about, and here's sort of the takeaway, when we're talking about risk to reward, really we're implying that is the initial risk to reward. And like I said, if you have a 1-to-1 or a 2-to-1 or you just set it and forget it, this metric really won't apply too much, but you have to do that all the time. But if you ever is a situation where you're moving your stop, moving it up, or moving it to break even, if your average trade is 20 minutes long and the average time that you're moving your stop is 2 minutes into a trade, well, your overall risk on a trade is not 2-to-1 or 1-to-2 or whatever it is. The initial risk reward is that. We're not talking about risk here. We're talking about exposure, and they're two different things, all right? The maximum risk, all right? Maximum risk is the ultimate exposure. If everything went wrong the first second, you got stopped out. But exposure is really weights the amount of time that you're exposed to that initial risk. And if you're moving your stop rather aggressively, well, your overall risk is much less, even though the initial risk may be sort of difficult to communicate to an investor. Say, you're risking more than your target is, right? Your profit potential is. So we're looking here, and this is very aggressive, this sort of advanced risk analytics, and insurance company underwriters use this type of methodology as well. It's what is your exposure? And when you move your stop during a trade, you're reducing your exposure. But we tend to, and in all fairness, the whole industry does this, we look at risk reward as your initial risk reward. So an advanced way to look at your risk reward is saying, well, how aggressively am I moving my stop? And does that affect my exposure? Well, it absolutely does. It's just math. All right. Now, I like to keep stops really, give myself some room, because if it goes against me, I like to be able to manage that to maybe get out of the trade with a partial loss. So one of the KPIs I look at is not necessarily risk reward. It's what is the percentage of stop outs that were total stop outs. And they should be about 12 to 16%. That's just me. All right. If I have a total stop out rate of around 20, 22%, it's probably going to be a failed strategy for that period, that month. So think about that. I know it's a little advanced, but I thought I'd throw it at you. And again, I'm trying to communicate this to, quote, investors who are relatively savvy, but it's still a challenge for them. They're just so focused, and they've had experience with this stuff where we just constantly blurt to them that a risk reward is the initial one. But once you move that stop, you can't look at it that way. All right. And if you move your stop aggressively, and really 80% of the time that you're exposed to the trade, it's at a stop that's less than the initial, well, everything should be more advantageous. Your risk of ruin should be going down. So think about that concept. This is, again, advanced analytics. Give that a shot. Click on the link below, and I'll do a little cheat sheet to explain how we do this at the quant level and at the investor level, and see. Maybe it's something that you can use. Maybe you're managing some small funds, or maybe you're just managing prop capital. An impressive conversation to have with the risk manager there at the prop firm. All right, give it a shot. Let me know what you think. Let me know if I'm totally off base. Okay, that's fine. There's so many ways to do this. And the most important thing is if you have a solid profit factor over a good series of trades, you don't have to worry about any of this stuff. All right, just continue doing what you're doing. Thanks again, and we'll catch you next time.